Happy New Year and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, we are going to address the question, why buy stocks? Then I'm going to give a portfolio update and talk about some milestones that I hope to hit within 2021 and some of my goals for 2021 with the portfolio. And finally, I will answer some questions which I have received from the audience. So let's jump directly to the question of why you should buy stocks. If we go and take a look at the 90-year historical chart for the S&P 500, if we start by looking at the last 20 years, even if you bought at the highest market price in 2000, just before the dot-com bubble, and if you have then sold all your stocks in March this year, you would still have made a profit on average. It would not have been a great profit compared to if you have bought at the market lows in September 2002 or even at the last economic crisis in February 2009. But you can clearly see here that the overall trend is upwards. I'm not trying to predict what a stock is doing a month from now, 6 months from now, or a year from now. I'm saying, where will the market be in 10 or 20 years from now? And this trend just becomes much more obvious if we actually expand and take the full 90-year history here, because you can see the trend is for surely upwards. And as you can also very clearly see here, that there will be periods of time where you will have to wait a long time. I mean, for instance, the drop we had from August 2000, I mean, it must have been horrible looking at your portfolio going down for 3 years in a row. But despite this fact, if you just keep holding on, then the trend is that you will make money in the long term. The other important point that I keep reminding myself about and keep talking about on this channel is, don't just buy a stock because someone else has done it. Because if you have bought a stock at the top of the dot-com bubble, then chances are that you would have sold out within the next 3 years if you don't know why you have bought this particular stock. And you can see that history repeats itself. So in 2007, if you have bought something there, then chances are that you would have sold out before March 2009. Or even this year, if you have bought in December 19 and then looking at it at March and seeing that you are down 30, 40 or even 50% or perhaps even 70 as I was on some of my stocks. If you don't know why you have bought the stock, then don't go and buy individual stocks. There's no shame in admitting that. Do like Jack Bogle. Don't search for the needle in the haystack, simply just buy the haystack. And buying the haystack meaning just buy the entire market through an ETF. If you don't want to spend time researching on individual stocks, chances are you will be better off simply just by buying the market, because the market long-term trend is upwards. So that is why you should buy stocks, but perhaps also why you shouldn't buy individual stocks. Because if you don't want to sit down, spend your time learning about how investing works, learning about individual companies, sitting and looking through accountings, then perhaps you are actually better off by buying an ETF mimicking the entire market, since that is the cheapest way for you to get a piece of the great performing companies which are out there. And if you look to my portfolio this year, we can see that I am actually down 8.63%, and I actually think that I know something about investing, but at least I'm staying humble and say there's always more to learn. And as you can see, the average of the S&P has increased by 16%, meaning that my performance is actually more than 24% worse than the market. So clearly you can say I have a lot to learn. So hopefully that can inspire me to make more content, make more videos, but also why I really believe that Jack Bogle are right saying for 99% of all investors, they are better off just by buying the market instead of trying to pick individual companies. And I acknowledge that fact. If we then continue with a portfolio overview, then we can start by seeing that there's a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. So if we go to the portfolio value tab here, then we can see that the cost of the portfolio has increased with $3,800 and the value is up by $4,000. So I have had a little capital gain in this week. If we then go back to the overview tab, then you can see that the cash line is now empty because I have invested all the cash. I have also included a bankruptcy line, and you can see that I have removed the line with Tailored Brands here, since they have now finally been declared bankrupt and all my stocks have been sold. Unfortunately, all my stocks were sold 31st of December 2020, meaning that I will have the loss of the stocks in 2020. And if we go to the history tabs here, then you can see that I have added my bought value and my sold value of Tailored Brands, so you can see that I now have a total negative profit in the portfolio for 2020. And unfortunately, Revolut did not inform me that this was going to happen on the 31st of December, so I had no chance of selling other stocks to try and do some optimizations when it comes to the taxation. So that is just another thing with Revolut where I don't think that they're doing an outstanding job. I think that that is actually below what is market standard. It would have been nice with a heads up. I mean, they should inform you prior to an event like this happened. It shouldn't be me who's asking what has happened. But when I asked, they actually delivered a link so I could go and see for myself on the latest press release from Tailored Brands that they indeed has been declared bankrupt and now they have done a restructure. Unfortunately, that restructure means that all previous shareholders have been left with no money for their investment. So that is why I have added this $3,000 loss into the portfolio under the history. I will of course leave a link in the description below so you can see this press release for yourself if anyone is as unfortunate as me and have been owning stocks in the previous company. And as I explained previously, you could see that the cash line has now been removed. So let's take a closer look at what I have actually spent the cash on. So if we scroll up through the portfolio, then we can see that there is an entirely new holding in the portfolio, namely Bristol Myers, which is a pharmaceutical company. They are in the healthcare sector. And you can see that I have invested a little more than $8,000 into that stock. So before we take a closer look at why I have added Bristol Myers into the portfolio, then let's head over to my favorite part of this spreadsheet, namely the dividends tab. Because you can see with the addition of Bristol Myers, I have added more than $250 in annual dividend income. And if we take a look at the dividends tab here, we can see that the December dividends received was very close indeed to the September. The only difference being 18 cents, and that is due to the fact that Starbucks has increased their dividends since September. But since I only have $500 worth of Starbucks, it was only 18 cents. And we can also see that I in total received $2,033 for 2020 in dividend income. But what is truly encouraging to me is when I see these numbers. I mean, look at the estimated yearly income that I'm going to receive in 2021. It's close to $900 more than what I received in 2020 just by the holdings which I have now. So one of my milestones in 2021 will for surely be to hit $3,000 in yearly estimated income, and I actually hope that I can reach 3,600. And why do I have a particular milestone of 3,600? Well, that is because that is $300 on average per month. So I'm trying to find these small increases on different targets, which I will be truly happy to see. And the reason why it is a milestone and not a goal is that I don't exactly control the outcome. My goal should be something that I can control. So for instance, I have a goal of investing at least $1,000 into dividend stocks every month. And that is something that I can control. And when 2021 has passed, let's see how much I actually average to invest every single month, because I'm trying to invest as much as I possibly can. And the reason why I have quite modest amounts that I want to add is because I want to make sure that I can fulfill my goal. So let's look at the calculations for how much it will actually require from me to hit my milestone of 3,600 in yearly dividend income. So if we take the dividends which I'm projected to receive in 2021, and then we have the cost of my portfolio, then we can take my dividends and divide by the cost, and that gives me an average dividend yield of the portfolio. If I then use that average dividend yield as my best proxy for new investments into the portfolio, then we can see that I will have to increase my dividends by $702 to achieve my milestone of 3,600. So if I am to increase my annual dividend yearly income of $702 and then divide by the average yield of 2.78%, then it will require that I invest a little more than $25,000 in 2021 to achieve that milestone. So perhaps I'm not going to achieve that milestone this year. I will for sure try my best, but I'm also staying realistic and say perhaps I simply am not capable of saving such a big amount so I can reach that milestone. And that is why I am constantly focusing on goals which I can actually do something about. So my goal will be to save as much as I possibly can and at least $1,000 a month, which I can invest into the portfolio. So this thing about having an estimated average yield, I thought that was actually a pretty good idea to have that, so you can see what the average yield is for the portfolio as well. So I have decided to add that under the dividends tab. And on the overview, I have decided to include this bankruptcy cost, you could say here. Now it's much more clear what it is. Before I simply had to have the line here of tailored brands, but who knows, perhaps I will have more companies who will bankrupt and then I can include them here as well, and now they are also part of the history tab as well. So hopefully all of this gives you a better overview. That is at least the intention from my side. Let's turn to Bristol Myers and let me try and explain why I think this company really suits my portfolio. So first of all, we have to look at the guidelines which I have mentioned back in episode 2. And for those of you who are new to this channel, I mentioned the guidelines in episode 2. I have just brought them to the screen now so you can read them for yourself as well. Just pause the video. I will simply just walk through the guidelines in my latest purchase of Bristol Myers. So if we start by going to Seeking Alpha and looking up Bristol Myers, BMY in ticker, then we go to the dividends tab. We can see that we have a yield above 3%. That is pretty good. We have a payout ratio which is well below 75%. We can see that they have a good dividend growth history of 14 years. And if we take a closer look at the dividend history here, then we can actually see that they have paid out a consecutive dividend since 1989. But since they didn't manage to increase it here back in 2007, they have only increased it in 14 consecutive years, even though they haven't dropped it since 1989. So that is actually a really strong dividend growth history. So that is guideline 1, 4, and 6 covered immediately. If we then go to the dividend yields tab, we can also see that the dividend forward yield is above the 4-year historical average, suggesting that this is perhaps not the worst time to buy the stock either. So that covered guideline number 2. If we then continue to the peers tab, just to see how the PE ratio stacks up against its competitors. If we then scroll down here, we can see that the PE ratio is well within line with its peers. We can actually see that it has a lower non-GAAP PE ratio than all of its competitors. So that covered guideline number 3. If we then continue with guideline number 5, diversity across sectors, then you can see with the addition of Bristol Myers, now my healthcare percentage of the portfolio is close to 33%. So perhaps I should consider diversifying more next time that I'm buying something. For now, I'm okay with having a third of my portfolio into the healthcare sector, but you can very clearly see here that perhaps I should add some energy or consumer discretionary or even communication services, because they are much lower percentage wise in the allocation of my portfolio. But what exact portfolio allocation percentages that you want is completely up to you. Currently, I just feel that Bristol Myers was quite undervalued and that they really fit into my portfolio. Hence, that's why I have decided to add them. But I am very well aware of the fact here that perhaps it was not the best choice when it comes to diversification in the portfolio. And finally, we arrive at guideline number 7, strong company potential and a good moat. So if we take a look at their revenue here, we can see that they have been steadily increasing their revenue, and especially here in 2020, they have done a tremendous job. So that is one of the things that I really think speaks for itself when it comes to strong company potential. And when I look to the dividend history, this thing about that they have been paying a steady and increasing dividend almost since 1989. I know that there has been some years where they didn't increase, but at least they didn't decrease it. And that is where we have crossed the dot-com bubble. We had the financial crisis in 2008. So I really think that this is a robust company. So that is the reason why I have decided to add Bristol Myers into my portfolio. So all of that, of course, sounds very good and very promising, but what are some of the risks associated with investing in a pharmaceutical company like Bristol Myers? Well, one of the things which immediately comes to my mind is when you're investing in pharmaceutical companies, these companies will always have a large spending on research and development, because if they don't have a large cost in research and development, then all of a sudden their pipeline of drugs will run out and their patents will expire, meaning that they won't be able to continue to make money going forward. So it's also a bad measure to say, oh, I want a pharmaceutical company which is not investing a lot, because now the profit will look much better, but they will only look much better for a shorter period of time. Because if they are not investing a lot in research and development, then they won't continue to stay on top and have the next big drug which will make them a tremendous amount of cash. If we then continue to questions from the audience, then I have received a question that goes like this. Hey LMG, what is your favorite stock in your portfolio and why? So first of all, thank you very much for that question. It's actually harder to answer than I initially thought, because within the 27 companies in my portfolio, there is actually quite a lot of them which I'm really happy to own. So which one is my favorite and why? I mean, Unum Group, for instance, I'm really happy that I bought it at the time when I did, because I really think it was undervalued at that time when I bought it. You could of course also argue and say, well, then I should look to Starbucks and be really happy that it has gained 36% since I have initially bought it. But I don't think that Starbucks was that undervalued when I bought it. So just from a valuation perspective, then Unum Group could be a good candidate. But if I have to answer and only pick one company in my portfolio which I would be happy to own in a very long time, then I think I would actually choose Store Capital, since I believe they have the best CEO, and I really think that their business model is amazing. So let me try and explain what I mean when I say that they have a really well run company. To my understanding, they have almost perfected making the risk on a high cap rate acquisitions to near zero, since they have intimate knowledge of their tenants' financial situation. So classically, high cap rates means high yield on rents. Typically, this is seen as higher risk, higher reward, higher losses. Since a store requires their tenants to report their financial situation to them, they select for profit centers which tenants would be reluctant to let go of in terms of leasing. This reduces the risk of bankruptcies at Store Capital. They also work closely with their tenants in time of need, which we have seen during COVID-19, they have given some of their tenants rent relief. So this is actually also the business that you want to have in your portfolio, that they actually take care of their clients to build long-lasting relationships. And in Q4, they actually reported that they have collected more than 90% of their rent, even though most of their leasing is to zero investment grade tenants. This just proved to me how strong the business model is. The only thing that I am not happy with about Store Capital is that I didn't manage to pick them up in March during 2020, because then I would for sure have made a much better deal. So hopefully that answered your question about what company I would choose in my portfolio if I could only choose one, and why. So that actually sums it up for the first week of 2021 with the Lazy Money Game. So hopefully all of you will have a happy new year, and I wish you all the best in your investing journey. And if you like content like this, then please consider leaving me a like, giving a comment, or remember to subscribe. That really helps out the channel. And until I see you next Sunday, bye!